It's been almost a sort of cognitive dissonance because we started with the hard landing, then we got into a soft landing. There was also a period of no landing scenario when you saw a pretty significant rise in 10-year US bond yield. And now with the weakness in data, it seems like the soft landing scenario is back in play. Our view is that we'll have a sort of soft slowdown in the US in the second half of next year. We don't see a recession in Europe. Because the bottom line is that you have tightening monetary policy against still loose fiscal policy that is making the economy a lot more resilient than expected. And last but not least, you have companies which have developed a natural immunity against inflation and interest rates because of greedflation and also because of balance sheet repair. So we can talk about these 2 points later on, but I think these are pretty powerful forces that prevent a sort of collapse in the economic activity.
I love you starting off with cognitive dissonance, because I think part of that cognitive dissonance is the fact that people are refusing to look at history and look into economic history and look at market history as well. And in their refusal, they're not looking at how long cycles normally take or how long lag effects of interest rate hikes take as well. And it just seems to me everyone's writing off the prospects of some real damage to global economies from interest rate hikes and quantitative tightening. But history would suggest it takes time. It always takes a little bit longer. It can take a couple of years from the first rate hikes to really come through as well. Are we missing the point here and getting too glib and too relaxed too early?
I mean, there's this quote that says history is a good indicator of future performance. Well, it's bad. It's not always a good indicator of future performance. And I think we are in a very unusual environment because I think the original sin, so to speak, when it comes to the fight against inflation has really been this fiscal whatever it takes response to COVID to save human lives. So there's a huge amount of kinetic energy in the system that is sort of expanding. And this is where you have, greedflation, which led to super high profit margin. But you also have excess savings in the US that reach close to 10% of GDP at $2.5 trillion. And all of that requires a lot more tightening, and yes, I sort of agree that it needs at least a few years before hitting the economy.
Can we talk about what the transfer of energy has meant to markets? Because what we've seen recently, in recent weeks in particular, stateside, the markets moved off the sidelines fairly aggressively from a cautious summer. They've pivoted back into equities, risk on trade, and they've also put money back into the bond market. Is that the right allocation based on what you see economically and with fiscal and monetary policy?
Yes, I mean, I think when you started the year, the consensus view was that we'll have a recession. It was even priced towards the end of this year, then it got pushed back. So a lot of investors were long bonds because they typically do well when you have a recession in anticipation of rates cuts. And then we saw profit margins surprising to the upside because companies were able to raise prices by 10%. For example, when volume were decreasing because of cost of living crisis. So through the operating leverage, you had pretty strong earnings growth. And as a result, they were forced back into equities. But I think what's happening today is that allocation into bonds has fallen. You have more money into equities, but there's a new player in town, and this is cash. Because we used to be in the TINA world, there is no alternative, and today cash yielding 5 and 5.25% is a good source of stability in a portfolio to wait for things to play out in terms of the economic slowdown. So this is decreasing the liquidity in the bond market and creating a new allocation where cash is playing a bigger role.